There is an invisible battle going on in the UK healthcare space between two REITs that both try to grab the best properties and win the trust of most investors. Both of them have been hit hard with the rise of interest rates and are trading well below their levels from 2 years ago. This dip has also pushed the dividend yield to quite high levels, making these stocks very appealing for dividend investors. I am talking about Primary Health Properties and Assura. But the question is, can the companies recover from this hit? And is the dividend yield really worth it? Well, in today's video I'll break it down. We'll compare the business model of both of them, have a look at the general market they are operating in, and look at their latest financial statements to see how they are doing. I'll also check the valuation to see if now is a good time to buy. In the end, we'll want to answer the question, which of the two is the better investment? So sit back, relax, and let's explore the investment potentials together. My name is Florian, and I provide a more scientifically inspired stock analysis on this channel. And thank you so much, Phil and Nigel, for suggesting these companies. If you have any suggestions for companies that I should cover next, please let me know down in the comment section. And now, let's get started by first comparing the business models and see where exactly the differences are. Both companies are included in the FTSE 250 index with almost equal weight of 0.4 something %. Their business models are quite similar, and it took me quite some time to figure out that there are some distinctive differences and where exactly they lie. Both companies work in the healthcare property sector, and their main focus is on the primary care and pharmacy market in the health service industries. Mainly in the UK, but both also own properties in Ireland. The exposure of primary health, or PHP, to the Irish market is much higher though, with more than 30 properties versus 1 developed and 5 under development properties of AGR. And while Primary Health Group owns 540 properties with a value of £2.8 billion, Assura owns exactly 100 properties more, namely 614. But the total property value is with £2.7 billion, even a bit lower than PHP's. So it seems like PHP has the more expensive properties of the two, and in real estate this could mean 3 things. Either bigger properties, higher quality properties, or better locations. Or of course, a combination of all 3. And when we compare the portfolio distribution between the two, the biggest part for both of them, value-wise, is the category of properties with a value of £10 million and higher. But in the smallest category, with a value of 1 million or smaller, Assura has almost 10 times as many properties as PHP. So we can already guess that PHP is probably putting a higher focus on quality over quantity. The WAULT is with over 10 years pretty long for both companies. WAULT stands for Weighted Average Unexpired Lease Terms, and this gives a snapshot of how stable and predictable the rent income is over time. So it is quite an important metric for such a REIT. A higher WAULT suggests that most leases are long-term, providing more security for income, while a lower WAULT indicates shorter remaining lease periods. What is better actually depends on the economic situation, but a long WAULT, especially with inflation-linked or index-linked rent, gives a greater security and predictability. Both companies have the majority of their leases without any inflation link though. Unfortunately, I couldn't find the exact number for AGT, but in case of PHP, 2/3 of their UK portfolio are reviewed on an open market basis, typically every 3 years. Their portfolio in Ireland is fully linked to the core inflation though. So both companies are a bit limited when it comes to rent increases, but the lease terms are very long for a REIT. The EPRA cost ratio is a measurement of the European Public Real Estate Association to bring more transparency over operating costs, including overheads, joint venture expenses and management fees to investors, and provide a reference point for the company's costs. In case of our two companies today, these EPRA costs are quite low when compared to other REITs. Primary Health has a cost ratio of around 10%, while Assura sits at a still very low 13.5%. These costs don't include vacancy costs, and in case of PHP also still don't include the costs of the Access business they acquired in 2023. Speaking of acquired, here we find the first big difference in their business models. PHP focuses on the management and investment of healthcare properties. They don't develop their own properties, but rather grow through buying newly developed properties and investing in already developed ones. They also grow through the acquisition of other property managers, like for example Access Technical Services in 2023. What is remarkable is that 89% of their rent is directly or indirectly paid by government bodies. One of the bigger risks for such REITs is that tenants or operators can't afford to pay the rent anymore. I actually experienced this firsthand with my by far worst investment that I did. I had a position in Medical Properties Trust, which is also a REIT in the US healthcare sector, and back in 2022, their biggest operator of hospitals got into trouble and could not afford to pay rent anymore. This was one of the main reasons why Medical Properties went on a 2 years downward spiral and the stock lost 80% of its value. So the fact that the rent is quite secure from these government contracts is a huge plus in my book. Assura has a slightly different approach in that they try to grow more organically by developing their own properties. They are also still investing and acquiring properties from other developers, but their focus is more on individual properties instead of whole portfolios. In their last fiscal year, acquisitions made up around 15% of the property additions, while the remaining 85% were developed by themselves. And one of the crucial benchmarks of the quality of the service they provide is customer satisfaction. Unfortunately, this did drop quite a bit in 2024. Right now, their customer satisfaction is only 70%, well below the minimum target of 80%. I really appreciate that they still disclose this metric in their report, and AGR already has identified the issues and prepared a plan to restore this in the coming months. So I wouldn't worry too much right now. But this is still a trend that needs to be observed if you are an investor in the company. So now that we understand the business models with the similarities and differences between both companies, let's check how the healthcare property market in general is doing in the UK and if our companies can benefit from tailwinds or if they will have to struggle to keep growing in the next few years. First, we should know that the healthcare market is somewhat decoupled from the economic growth and is linked more to demographic developments than to the economy. And it probably is no surprise to you that the population in the UK is expected to get older and older over the next decades. This is happening slowly though, so there can be other short-term trends that overshadow this. But we can already see that the waiting list for treatments are getting longer and longer. This trend has especially picked up speed in the recent years since the pandemic. And it comes at a time where the UK government is dialing back their investments in primary care compared to other sectors in the healthcare real estate industry. Here we see that the investment volume in primary care in 2022 has decreased quite a bit from the last 5 years. All this leads to a stretched supply while the demand further increases. This has already led to the trend of repurposing existing properties that were not originally intended for healthcare use to do exactly that. But this can't be a long-term solution, and the demand for purpose-fit modern properties will further increase. This demand is also reflected in the rental increase that both companies could realize in the last years. These numbers here are from PHP's annual report, but the same is actually also true for AGR. The numbers show that the rental uplifts in 2023 have reached the highest levels of the last 15 years. And this, of course, helps to push the rental income. So we have not one, but actually 3 different trends going on that help both companies. First, the demographic shift and the increase in waiting time for treatments. Second, the increasing gap between supply and demand. And third, the rent increases. So overall, I think it is safe to say that both can benefit from secular tailwinds. But is this also reflected in their performance? I already mentioned in the intro that the total return in the last 2 years wasn't too great for both companies. In the last year, Assura had a negative performance of minus 1.5%, while PHP could deliver 10.7% of total returns. And this becomes even worse when we look at the last 5 years. Here, both companies delivered a negative return of minus 70.5% and minus 11.8% respectively. But REITs in general had a hard time over the last years due to the increase in interest rates. When we look back even further at the last 10 years, both companies did deliver positive returns of almost 130% in case of PHP and still around 80% for AGR. And while this doesn't sound too bad, it is still way below the total return of the S&P 500 that did return 240% in total to their investors. But past performance is no indication for future returns, so we should ask ourselves, how are their businesses actually doing? For the financial analysis, I'll try something a little different today to better compare both companies. So instead of looking at the charts directly, as I usually do, I prepared a direct comparison for 5 categories: growth, financial health, profitability, dividends, and valuation. Please leave me a comment to let me know if you like this type of comparison or rather prefer my regular approach where I show the charts directly. So let's start by comparing the 5-year growth of our contenders. Here we see that PHP can win in all categories with a nice double-digit growth rate in top and in bottom line, while Assura comes in at roughly half of these values. Instead of the net income that I use for regular companies, I use the funds from operation or FFO here because this is just more meaningful for REITs. And the FFO as well as the EPS did decline for both companies on a 5-year basis. In Assura's case, both of these values are currently negative. That's why I can't give a value here. So primary health can easily win in this growth category. For financial health, the picture changes. Here, Assura can beat PHP in all 3 metrics: net debt to EBITDA, share dilution, and loan to value. The difference in net debt to EBITDA is not so huge between both companies, and in both cases it is either way quite a bit higher than what I normally would like to see. The same is actually true for share dilution. Both companies did dilute their shareholders on quite a high level over the last 5 years. What is interesting about the loan to value is that this value is much lower for the average UK real estate company than the European average. But both companies today have a value that sits even above the European average. This is important because a higher loan to value ratio indicates a riskier investment. And while the long-term debt is also very similar for both companies, the average cost of debt, or in regular language, the interest rate they have to pay, is quite a bit different. Assura has an interest rate of 2.3%, while PHP has to pay a full percentage point more with 3.3%. And we also see this in their interest rate payments that are roughly 1/3 higher for PHP than for AGR. The average debt maturity is quite similar, with 6.6 years for PHP and 6 years for Assura. So overall, Assura is the winner in this financial health category. In profitability, Assura has the better free cash flow yield with 2.5% versus 1.9% for PHP. They also have the higher operating margin with 82% versus 76% for PHP. But the return of invested capital is higher for PHP, although both are pretty low here. But overall, Assura takes again the win in this category. For dividends, we have a bit of a mixed picture. The dividend yield is quite high for both companies, but with 7.72%, Assura can beat the 6.6% of PHP. In dividend growth, it is the same. Here, Assura can also win with a 5-year growth CAGR that is 2% above that of primary health. But the payout ratio looks quite high for both companies. For PHP, it sits at around 100%, so they pay out all their funds from operation to their shareholders. But as we just saw, in case of AGR, The net income and the funds from operations were negative this year and also last year. But that really isn't as bad as it sounds at first. The main reasons for this decline are increased development and investment costs. So to me, it seems like the company has used the decline in real estate prices to increase their development pipeline. So the company might be able to benefit from this in the future. Their cash from operations is also still increasing on a year-to-year basis, so I don't see any issues with their operations. But of course, this also brings some risks. Because in order for the company to earn enough money to pay and even increase the dividend, they need to find a way to balance their operations with their investments. Both companies do pay a stable dividend though and have not cut or decreased it in the last 10 years. Overall, Assura would take the win in this category with 2 points versus 1, but to be honest, I would immediately rule out Assura for my personal investments due to its payout ratio being over 100%, which is a huge red flag for me. So let's call it a draw here. For the valuation, I used the funds from operation again and also the net asset value because it gives a clearer picture for REITs. The price to FFO in case of PHP is 15.5, which is slightly above the sector median of 14. For AGR, we can't give a value here as, again, the FFO is negative for them. For your money, you also get around double the net asset value per share with primary health compared to Assura. To determine the fair value, I use the dividend discount model. This takes the dividend per share, the dividend growth and the cost of capital into account. And because the dividend growth rate is actually on a similar level as their costs, the fair value in this case is rather low. This model gives a downside of minus 71% for PHP and even minus 84% for AGR. But don't worry, we look at the Analyst's forecast in just a second and their expectation is actually quite a bit better. But before we go there, let's see who did win the valuation battle. And with 320 points, PHP is the clear winner here. And when we sum this up and take our score, we actually have a draw here. Both companies could win 3 points. And while PHP wins in growth and valuation, AGR has the better financial health and higher profitability. So not only do we have a very similar business model, both companies are also fairly even when it comes to their current operations. The differences between both of them are not very large, in most cases even within the individual categories. But there is one last remaining question that we need to answer before we come to our conclusion. And that is, how will the companies perform in the next couple of years? So first, let's see what the analysts expect from primary health properties. The average 1-year price target based on the forecast from 6 analysts is 14.3% higher than today's price. The downside seems very limited with only 0%, and basically all analysts expect that the price in 1 year will be higher than today. The earnings per share should not grow though, and the expected EPS value in 2027 is the same as today. Revenue-wise, it should grow with a CAGR of 3.7%. In case of Assura, the picture is, who would have thought, quite similar. Here, the 1-year price target based on 10 analysts is even 18.5% higher than today, with the lowest estimations still almost 7.5% higher than today. The EPS of Assura should grow with a CAGR of 7.5%, but keep in mind that it is negative today. So the initial situation is quite a bit different from PHP. The revenue growth is expected to be a bit over 4% annually until 2027. So when we compare this side by side again, it becomes quite clear that Assura is expected to grow a bit quicker compared to PHP. But please keep in mind that the initial situation between both of them is quite a bit different. And I would say that with the positive funds from operation that primary health properties has, they definitely have the more stable and less risky position at the moment. Before we sum this up, if you like the video and feel like you learned something from it, please smash the like button and subscribe to the channel so you don't miss out on my next analysis. And now, let's come back to the question, which REIT is better? Before I started my research, I actually didn't know any of the two companies, let alone consider them as an investment. Now that I did the homework, I find their business models quite interesting, and both are definitely operating in an interesting and growing market that will stay relevant over many years to come. And while PHP's fundamental growth is expected to be better and its valuation is lower, AGR can score with an ever so slightly better financial situation and profitability. But the negative earnings and funds from operation from Assura that are leading to a dividend payout ratio of over 100% are disqualifying it for my investments. I also strongly dislike the high share dilution for both companies, but especially PHP, where the dilution rate exceeds even the dividend yield. This means effectively the company is diluting shareholders faster than they receive dividend payouts. This trend has just shifted last year, so going forward it might be a bit different, but that's just speculation at this point. If you are willing to take on these risks, AGR seems like the better candidate in the short run, let's say the next couple of years. As a long-term investor, I would slightly prefer PHP though. You might ask yourself now, but Florian, why? And the reason is quite simple. I'd very much prefer the stability and safety that PHP can offer with their government contracts compared to the higher short-term growth of Assura. For investors looking for a stable and high dividend, and let's be honest, these are probably most investors looking at these companies, I just think that stability is more important. But I am also always investing with a time horizon of at least 10 years, and I am not so keen on a high dividend yield. So please take this into account when considering your own investments. And if you haven't guessed it already, I am not invested in any of the two companies. And please, before investing, do your own research and only use this video as a starting point for your own analysis. And if you are looking to build up a passive cash flow, you probably don't want to miss out on my analysis of this unique and first of its kind REIT in Europe that even pays a dividend yield of 8% at the moment. That being said, thank you so much for watching guys, and see you in the next video.